Good morning everyone. It is a pleasure to be with you, from my Economy and Finance channel. I hope you are doing very well and are ready to acquire new knowledge in this very important field. Today we will talk about the main macroeconomic indicators. Start. The trade balance refers to the difference between the value of a country's exports and the value of its imports. If a country exports more than it imports, it has a trade surplus. If you import more than you export, you have a trade deficit. The trade balance can be an indicator of a country's economic strength, and it can have an impact on the exchange rate of the country's currency. The interest rate is the price paid for the use of money. Interest rates can be adjusted by central banks to control inflation and the economy as a whole. Lower interest rates can spur economic growth, but they can also lead to increased inflation. Higher interest rates can dampen economic growth, but they can also help tame inflation. This is an indicator that measures the change in the price of a basket of goods and services consumed by households. The CPI is used to measure inflation and is a key indicator for monetary policy decision-making. The Consumer Confidence Index measures consumers' opinion of the current and future economic situation. It is an important measure of confidence in the economy and consumer spending. This index can provide valuable insights into consumer trends and consumer confidence, which in turn can influence the investment and spending decisions of businesses and consumers. It is also considered a leading indicator, meaning it can give clues about the future direction of the economy, before they are reflected in other lagging indicators, such as GDP or employment. Producer Price Index, PPI, measures the change in the prices of goods and services produced by firms. The PPI is used to measure inflation from the perspective of producers. Unlike the CPI, Consumer Price Index, which measures prices to the final consumer, the CPI focuses on prices in previous stages of the production chain. To construct this index, the prices provided by companies are used, relative to the goods and services representative of a country's production. Then the index is calculated in a weighted manner, taking into account the products and services of greatest importance or weight in the economy. This is the investment made by foreign companies in a country. It is an important indicator of foreign investors' confidence in a country's economy. The exchange rate is the rate at which two different currencies are exchanged. It is an important measure of an economy's competitiveness in international trade and its relationship with other economies. If you liked this video, be sure to subscribe to our channel and activate the notification bell, like, and share with friends and family, so they can benefit from our financial information and our financial tips. Have a great day, and see you in the next video.